You're at a red light. To your left is a brand new luxury SUV that screams, "I'm winning at life." But what if I told you statistically, the person in the boring paid off Honda on your right is far more likely to actually be winning with money? Stay with me, because by the end of this video, you'll know which driver is secretly rich and how you can become that person without living like a monk.
Hey, it's your favorite Robert Money Nerd back on your screen. Today, we're tearing apart one of the biggest money illusions in America, the belief that a flashy car equals financial success. We're going to walk through real numbers on car payments in the US right now. We'll see how much debt people are quietly drowning in. We'll look at what actual millionaires drive, and we'll see how boring cars turn into very unboring bank accounts. Before you click away, here's the deal. About halfway through this video, I'll show you how one simple car decision can add roughly the price of a starter home to your net worth over time. And near the end, I'm going to give you a 3-step boring car rich life game plan you can start this year. And no, I'm not going to tell you to drive a 1998 rusted minivan with no AC. Unless you live in Alaska. Then we can talk. Let's go back to that red light. On one side, brand new Mercedes-style SUV, black paint, tinted windows, probably a payment bigger than most people's rent. On the other, a 4 or 5-year-old Honda Civic or Toyota Camry, nothing special, probably some scratches and a baby on board sticker from 3 owners ago. Here's what usually happens in our brains. We see the fancy car and instantly assume, that guy is rich. I must be behind. I should probably upgrade my car too. That's status signaling, using visible stuff to tell a story about success. In Q3 2025, the average new car payment in the US hit about $748 a month. Used car payments average around $532. That's just the average. Plenty of people, especially in states like Texas, California, and Florida, are paying over $1,000 a month for their ride. So when you see that gorgeous SUV, there's a decent chance you're not looking at wealth. You're looking at a 69-month chain around someone's ankle. And if your car note is bigger than your grocery budget, congratulations, your car is eating better than you are.
Let's zoom out and look at the country for a second. By the end of 2025, total U.S. household debt, mortgages, student loans, credit cards, auto loans, was around $18.8 trillion. Auto loans alone are roughly in the neighborhood of $1.6 to $1.7 trillion, making them one of the largest chunks of consumer debt, just behind mortgages and basically tied with student loans. And it's not just the total amount, it's the trend. Household debt grew by about $191 billion in just Q4 of 2025. Delinquencies, people falling behind on payments, have ticked up to almost 4.8% of all debt. For student loans, serious delinquencies are especially ugly. But auto loans are also seeing more people struggling as high payments collide with rising living costs. In a few minutes, I'm going to show you how one car purchase can quietly erase $60,000 to $70,000 from your future net worth without you ever noticing. We'll do the math together, so stick around if your current or next car might be a financial landmine. Quick gut check. Think of your monthly car payment right now. Now imagine never having that payment again and investing that money instead. How different does your life look in 5 years? 10? That picture you just saw in your head? That's the life the boring car driver is building.
Let's talk about one of the nastiest phrases in personal finance, negative equity. Negative equity means you owe more on your car than the car is worth. If you had to sell it or trade it in tomorrow, you'd actually need to bring cash to the dealership just to walk away. According to a Q4 2024 report from CarEdge and Black Book, about 39% of drivers with financed vehicles were underwater. They had negative equity. For cars purchased since 2022, that number jumps to around 44%. And here's the killer. People with 84-month loans, those super long, make the payment affordable loans, had a median negative equity of about minus $8,485. So imagine this. You've been making payments for years. You show up all proud to trade in your car, and the dealer says, "Good news. We can roll your remaining $8,000 of debt into your new loan." Translation? You now owe money on a car you don't even own anymore. That's like breaking up with someone and still paying their Netflix for the next 3 years. Except instead of, "Are you still watching?" your bank is like, "Are you still paying?" The long loan trend is real. Average new car loans run about 69 months now, almost 6 years. Non-prime borrowers are stretching to around 75 months. To make the monthly payment look tolerable, people are locking themselves into debt for almost a decade, while the car's value falls like a rock. Here's the weird twist. The boring car driver almost never has this problem.
They either bought used at a lower price or kept their car long enough to actually build equity instead of resetting the clock every 3 or 4 years.
Let's run a real-world example, similar to what serious finance folks have calculated. Scenario A, you buy a new SUV for around $52,000, pretty close to the average transaction price for a loaded new vehicle in 2025. You put $5,000 down and finance the remaining $47,000 over 72 months at roughly 6.5%. Close to average interest rates reported for new car loans. That puts your payment in the ballpark of the mid-700s to low 800s per month. Let's call it about $795. Over 6 years, you're paying around $57,000 back to the lender. Over $10,000 of that is just being interest, the fee for borrowing the money. Then you stack on insurance. For a new $50,000 plus SUV, full coverage can easily run over $200 a month. Many drivers are paying substantially more depending on zip code and driving history. Over 72 months, that's roughly $14,000 to $18,000 in insurance just to keep the car legal and satisfy the lender. Now add maintenance, tires, brakes, fluids, repairs after warranties expire. On a larger SUV, it's not hard to rack up a couple $1,000s over 6 years, even if nothing catastrophic happens. When you put it all together, detailed breakdowns show that a $52,000 SUV can end up costing around $80,000 over 6 years when you include purchase price, interest, insurance, and maintenance, only to be worth somewhere in the mid-$20,000 range at the end. That $50-something thousand gap between what you paid and what it's worth, that's money that evaporated into depreciation, interest, and fees. Scenario B, the boring car. You grab a 3-year-old reliable crossover, a Honda CR-V, Toyota RAV4, Mazda CX-5 for around $24,000 after the steepest part of depreciation has already hit. You finance it over 48 months at a slightly higher used car rate, say around 7.5%. Your monthly payment lands around $580. Insurance on a 3-year-old mid-range SUV might be closer to $140 a month. So your total monthly outlay is about $720 versus roughly $1,000 or more for the new SUV once you combine payment and insurance. That's a difference of around $300 to $350 every single month at the start. Years, that gap alone adds up to well over $20,000 in extra cash for the boring car driver. But here's the real spike. After month 48, the used car is paid off. The boring car driver's payment disappears, and their insurance may even drop further as the car ages. If they start investing the former payment, roughly $580 a month, plus that earlier $300+ difference in a simple U.S. stock index fund earning around 7% annualized over time, the opportunity cost calculation shows they could end up with something like $60,000 to $70,000 after those 72 months. Meanwhile, the fancy car driver is still sending over $1,000 a month to the lender and insurer for a car that's worth less than they owe for most of the loan. In a few minutes, I'll give you a simple checklist you can use before buying any car that tells you instantly whether it's quietly building your wealth or quietly destroying it. You'll be able to run this calculation at the dealership on your phone. Imagine the boring car driver opening their investment account and seeing $67,000. The fancy car driver opens their glove box and finds a stack of parking tickets and half a granola bar.
Now let's stop guessing and look at what people with real money actually drive. A large study on U.S. millionaires found that the top car brands among people with high net worth are not Lamborghini and Ferrari. They're Toyota, Honda, Ford, and Ford. In fact, one Experian-linked analysis noted that about 61% of individuals earning over $250,000 a year are more likely to own Hondas, Fords, and Toyotas than luxury brands. Dave Ramsey's national study of millionaires and follow-up reporting showed the most common brands in millionaire driveways were Toyota, Honda, Ford, Lexus, Subaru, and Acura, cars known for reliability and reasonable cost. Many millionaires paid around $30,000 for their last vehicle and often bought it used or kept it for a long time. So yes, your favorite tech billionaire might have a supercar somewhere in a garage, but the everyday millionaire next door? They're rolling up in a mid-range Toyota. They're dropping their kids off in a Honda, and they're quietly dumping thousands of freed-up dollars into index funds instead of paint protection film. The boring car becomes a symbol of something powerful: self-control, long-term thinking, and a refusal to let other people's opinions drive your financial life. It's wild. You might be judging someone's 2017 Camry. They're looking at you thinking, my car may be boring, but my compound interest is absolutely partying.
At this point, the math is screaming. Buy modest, buy used, hold longer, invest the difference. So why do so many Americans still choose the high payment, high debt option? First, signaling.
In the US, your car is one of the most visible signals of status. It's in the work parking lot. It's in the school drop-off line. It's in the neighborhood driveway. Our brains are wired to care about how we look to other people, and the auto industry knows this. They sell a feeling, arrival, success, confidence with every glossy commercial. Second, monthly payment framing. Dealerships almost never talk about total cost of ownership. They talk about just $7.99 a month, because our brains compare that number to our existing monthly bills, not to our net worth or long-term goals. One detailed analysis showed that framing a 6-year, $80,000 total cost as around $800 a month makes it feel like an overpriced subscription instead of a second mortgage. Third, the trade-in treadmill. Many people never experience what no car payment actually feels like because every time the loan is close to done, the dealer offers a deal to roll their current car, often with negative equity, into a new loan. The payment stays, the debt stays, the story changes from "I own this car" to "I'm always upgrading." The bank and dealer love this. Your future net worth does not. Fourth, fear of used cars. Marketing around warranties and peace of mind makes used vehicles sound scary, even though reliability data for 3-year-old Hondas, Toyotas, and similar models is excellent. The expensive warranty is often protecting you from a risk that's statistically small while costing you tens of thousands in extra purchase price and depreciation exposure. Here's the mental flip. Instead of thinking, "What will people think if I drive this?" ask, "What will my future self think if I buy this?" Your future self is the only person who has to live with your compounded decisions. All right, let's make this practical. Here's the checklist I promised. Screenshot this part or write it down. Step 1. Buy after the big drop. Target cars that are 2 to 4 years old in reliable brands: Toyota, Honda, Ford, Subaru, Mazda, Lexus, Acura, Hyundai. So the steep early depreciation has already happened. Check reliability data and avoid models with known issues. If you're still watching right now, you're in the top few % of people who are actually serious about changing their financial trajectory. I'm about to give you the one move most people never make. Step 2. Calculate total cost, not just the payment. Before you say yes to a car, pull out your phone and estimate. Loan total, price minus down payment plus interest over the term. Insurance for that specific car in your zip code. Gas to maintenance, projected depreciation, and insurance. Basic maintenance over the years you'll own it. Add those up and compare scenarios. New versus used, shorter versus longer term. Use realistic averages. New car payments around $748 and used around $532 nationwide. And check whether you're way above those numbers. If the total cost over the period you plan to own the car is tens of thousands higher for the flashy option, ask yourself, is this story worth $50,000 to $70,000 of my future net worth? Step 3. Commit to at least 12 months with no payment ever. If you already have a car loan, the moment that car is paid off is the most dangerous moment financially. Instead of rushing to upgrade, force yourself to keep that car for at least 12 more months. Take the exact amount of the old car payment and auto-transfer it into an investment account every month. Watch what happens. After a year of seeing those investments grow, you will never look at car payments the same way again. In 10 years, the difference between always having a car payment and driving a boring, paid-off car while investing the difference can literally mean the gap between feeling stuck and walking into retirement or financial independence with hundreds of thousands of dollars. At that point, you can buy whatever car you want. And the wild thing is, you probably won't feel like flexing anymore, because when your accounts are fat, your ego doesn't need leather seats. So, back to that red light. The luxury SUV is loud. It shouts, "Look at me!" The boring car is quiet. It whispers, "Check my net worth." Most people will keep chasing the story the car tells, but a small group, maybe you, will start chasing the math instead. If this video flipped how you see cars, hit subscribe. Every week we break down real financial decisions with the actual numbers behind them, so you don't have to learn money the hard way. Drop a comment and tell me, what are you driving right now? And what do you want your next car decision to do for your net worth? And if you're currently paying more for your car than for investing in your future, don't feel bad. Just remember, boring cars, exciting bank accounts. I'm your Robert Money Guide. Take care of your future self, drive safe, and I'll see you in the next one. Thank you.